So yesterday we saw the S&P 500 cross 7,600, officially closing at a historic 7,609.78. But if you look at the implied open this morning, U.S. stock futures are just completely flatlining right near those highs.
Yeah, it's a very tense pre-market.
Right. S&P futures are down like fractional 0.07% near 7,621. Dow E-minis are shedding 145 points, and the Nasdaq 100 is basically virtually flat around 30,674.
Right. But underneath that seemingly calm, flat implied open, I mean, the overnight session was actually pretty violent.
Oh, absolutely.
You've got this unstoppable AI infrastructure momentum running straight into some just brutal macro realities. The market is standing on the edge right now, deciding if this overnight setup translates into a massive gap and go sprint or, a devastating institutional reset.
And to understand why the market is holding its breath before the bell, you really have to look at the severe geopolitical catalysts that shocked the overnight session.
Yeah, the headline risk there is massive.
We're seeing reports of an Iranian missile strike on Kuwait's airport, which was then followed by retaliatory U.S. military strikes near the Strait of Hormuz.
Exactly.
Now, obviously, we are analyzing this strictly through the lens of market mechanics and physical commodities, because the immediate reaction in the energy sector is what is actually threatening the equities rally today.
Yeah, the physical reality of that conflict just instantly spiked energy prices. I mean, Brent crude oil surged over 1.6% overnight.
Pushing it right toward, what, $97.70 a barrel?
Yeah, exactly. Aggressively toward 97.70. And look, when oil approaches $100 a barrel, the implications go way beyond just the energy sector. It acts as this massive tax on the global economy.
Which is the absolute worst-case scenario for portfolio managers right now.
Right, because it reignites fears of sticky, entrenched global inflation. You have to remember, U.S. headline CPI is already proving resilient. It's hovering stubbornly at 3.8%. A geopolitical energy shock basically threatens to lock that inflation rate in place.
Which feeds directly into the underlying macro plumbing. I mean, if you're trying to value tech equities today, you cannot ignore this double-headed headwind.
No, you really can't.
Let's look at the first headwind here, the yield squeeze. We've already got resilient labor data. Joltis job openings just printed at a 2-year high. And now this overnight oil spike just adds fuel to the inflation fire. That combination has rapidly driven the 10-year Treasury yield up to 4.48%.
That's a huge move.
It is. Think of the 10-year Treasury yield like gravity for stock valuations.
Yeah.
Tech stocks are built on the promise of massive profits, 5 or 10 years down the line. When that yield goes up, that gravity gets a lot stronger.
Right, because the mathematical mechanism driving that gravity is the discount rate.
Yeah.
Analysts use the risk-free rate, which is heavily tied to the 10-year Treasury, to calculate the present value of those distant future earnings. So when yields spike to 4.48%, the discount rate rises, and it just violently compresses the current valuation of those long-duration assets. You just cannot sustain extreme forward multiples if the cost of risk-free capital is simultaneously rising.
And compounding that gravity is the second headwind, which is the dollar drag. I'm looking at the DXY, the US dollar index, and it's firming up into the 99.29 to 99.32 range this morning.
Classic safe haven bid.
Exactly. When geopolitical tension flares up, capital naturally floods into the US dollar for safety. But a surging dollar actively destroys the balance sheets of multinational tech companies.
Because of the currency exchange.
Right. When the giants that dominate the S&P 500 sell their hardware overseas, they collect revenue in foreign currencies. So with the DXY sitting above 99, bringing those foreign revenues back home translates into significantly fewer US dollars on their quarterly earnings reports.
It creates a severe fundamental drag right at the moment when valuations are the most stretched. I mean, the AI engine is redlining, pushing the indices to nominal highs, but the macro environment, the rising discount rates, the punishing currency exchange, it's fundamentally fighting the rally every single step of the way.
Which makes the current pre-market positioning incredibly dangerous. We are looking at a classic liquidity trap unfolding at these absolute highs.
Yeah, the divergence is crazy right now.
It really is. If you monitor the flow data, retail momentum is aggressively chasing yesterday's all-time highs. There is this pervasive sentiment among retail traders that the AI trend is just a structural inevitability.
Like it's completely immune to macro gravity.
Exactly. But while retail is buying the breakout, the institutional desks are freezing. They are staring at tech sector forward valuations hovering at an elevated 21 times forward PE, and they are holding their fire.
And that divergence between retail enthusiasm and institutional caution that is building toward the ultimate pain trade.
Walk us through that.
So institutional portfolio managers have been heavily underweight bonds, right? They've been riding the equity rally to generate alpha. But their risk models are mechanical. If the 10-year Treasury yield breaks past that 4.5% threshold,
And makes a run toward 4.8%.
right, if it runs to 4.8%, it triggers forced convexity hedging across the street.
Okay, let's unpack the mechanics of that forced selling. Because if you are a retail investor out there heavily allocated to high beta tech, you really need to understand how quickly institutional money can turn on you.
It happens in a flash.
Yeah. Convexity hedging isn't a choice for them, it's an emergency rebalancing algorithm. When bond yields spike, the value of their underlying bonds drops. To neutralize that sudden portfolio risk, institutions are mechanically forced to de-risk their equity exposure.
They just dump everything.
Right, they dump their highly liquid, high multiple, long-duration tech stocks and aggressively rotate that capital into cash or short-term paper.
And the worst part is that rotation hits the market exactly when retail is the most exposed. I mean, retail traders are fueling this gamma squeeze at the very top of the range. They're literally providing the exit liquidity for institutions that are quietly preparing to hit the emergency sell button.
If the bond market tips over.
Exactly. If that 10-year yield doesn't cool down, the valuation reset will be violent, and it will be incredibly fast. The bond market always dictates the ultimate reality for equities.
Okay, so if the threat of forced institutional selling is really that severe, we have to ask why the market hasn't already rolled over.
Right, the million-dollar question.
And the answer lies in the AI shield. There is a structural scarcity premium being assigned to hard tech right now that is basically temporarily overriding the macro data.
Yeah, look at the SOX yesterday.
The Philadelphia Semiconductor Index rocketed 5.9% in a single session. Investors are paying astronomical premiums for custom silicon, high-speed networking, AI servers.
Because physical data center infrastructure is the ultimate bottleneck for the entire artificial intelligence revolution right now.
Exactly. And the physical scarcity is driving some unprecedented price discovery. We are seeing the purest expression of this in Marvell Technology, ticker MRVL.
The volume on MRVL is just staggering this morning.
It's insane. The stock closed yesterday at $290.79. That was a 32.52% single-day gain. And this morning, it is gapping up another 10% on pre-market volume, finding an implied open somewhere between 318 and 324.
And the catalyst there wasn't even a standard earnings beat. It was essentially a king-making moment.
From Jensen Huang.
Right. Nvidia's CEO was on stage at the Computex 2026 conference in Taipei, and he explicitly anointed Marvell as the next trillion-dollar company.
Which is a massive statement.
Huge. The market is aggressively digesting this newly announced $2 billion partnership. It physically integrates Marvell's custom optical networking and ASICs, their application-specific integrated circuits, directly into Nvidia's NVLink Fusion ecosystem.
So Marvell is basically building the critical high-speed plumbing that lets tens of thousands of Nvidia GPUs actually talk to each other without bottlenecking the entire cluster.
Exactly. But the debate on the desk right now is whether this pre-market momentum is sustainable or if it's purely mechanical.
Right.
The bull case argues that we are in the middle of a massive unresolved gamma squeeze. Retail is buying out-of-the-money call options at such a ferocious pace that the market makers are literally being forced to buy millions of shares of the underlying stock just to hedge their books.
And if that institutional hedging momentum doesn't break, the bulls are targeting an extension up to that 330 to 340 level today.
Yeah, but the bear case is flashing a massive warning sign about overextension here. After a 40% move in less than 48 hours, the bears are looking for a violent rotation right back down to the 280 to 290 level to fill that technical gap.
And look at the SEC filings, too. Insiders at Marvell haven't been waiting for the $300 level. They have quietly unloaded $32 million in shares over the past 3 months alone.
Yeah, the smart money has been taking liquidity while the retail money is just blindly piling in.
Which brings us to the ultimate litmus test for the entire market today. The Marvell narrative is compelling, but the fundamental anchor for this entire rally drops today after the closing bell with Broadcom, ticker AVGO.
That is the print everyone is waiting for.
Broadcom closed at an all-time high of $481.57 yesterday, and the pre-market bid has it up another 3% to roughly $497.
Right.
They are essentially selling the most complex pickaxes for the AI gold rush. But this earnings print tonight will tell us if the market has priced those pickaxes to absolute perfection.
And Wall Street's models are demanding a lot. I mean, they're looking for $22.1 billion in overall revenue.
Which is a 47% year-over-year increase.
Yeah. But the microscope is entirely on the AI-specific revenue line. The whisper number on the street demands $10.7 billion in AI revenue alone.
That's a 140% year-over-year jump.
It is. The stakes here are entirely binary. If Broadcom delivers a decisive beat and raise, it will instantly vaporize that $500 psychological resistance barrier, and the resulting momentum will probably drag the entire S&P 500 up with it.
But there is a massive catch regarding their margins.
Huge catch. The models project gross margins to come in at 76.3%. In a market grappling with a 4.48% 10-year yield, any margin compression is lethal.
Absolutely lethal.
If Broadcom shows even a fractional decline in operating margins, or if their Q3 forward guidance shows any hesitation from the hyperscalers, the punishment is going to be immediate. Bears are going to target a rapid 10% plus correction right back down to that 440 support level.
So the hardware infrastructure side is operating on an absolute razor's edge today. But when you shift your focus to the software and platform companies that are actually buying all this expensive hardware, the valuation bar becomes even more brutal.
Oh, it's night and day.
Let's look at the divergence in enterprise tech, starting with Meta Platforms, ticker Meta. Over the last 3 trading sessions, Meta stocks lead 7%.
Yeah, institutions were getting really anxious over their Reality Labs capital expenditure projections.
Right, which are currently modeled somewhere between $125 billion and $145 billion. The street is demanding to know when this unprecedented cash burn actually translates into scalable ROI.
But then the sentiment completely reversed yesterday.
It did. Meta closed at $597.63, and it's rebounding about 1% this morning to an implied open of 603 to 605.
And the catalyst wasn't even a change in their balance sheet.
No, it was Nvidia's Jensen Huang stepping onto CNBC and explicitly defending Mark Zuckerberg's strategy. He literally said, nobody uses AI better than Meta.
Which just highlights this massive discrepancy in how the market categorizes tech spending right now. Because of Jensen Huang's golden stamp of approval, Meta basically gets a free pass on incinerating cash.
Right. Bulls are looking to recapture the 630 level, pointing to Meta's deep valuation discount relative to the mega cap cohort, and, leveraging the fact that Q1 ad revenue still grew 33% year over year.
But the bears are pointing to the regulatory risks of the EU and that persistent capex anxiety, arguing that if the broader market rolls over today, Meta is going to retest the 590 floor.
And contrast Meta's treatment with Palo Alto Networks, ticker PANW. Palo Alto is sliding 4.6% in the pre-market today. And the critical context here is that they actually beat their Q3 consensus expectations.
And they raised their full-year guidance.
Exactly. They executed perfectly against their models, yet the stock is being punished.
Because the market is completely bifurcating the technology sector right now. Meta's massive spending is viewed as structural AI infrastructure building. The market believes their endgame is architectural dominance, so they forgive the massive capex.
Right, but Palo Alto represents traditional enterprise software.
Exactly. Even when you beat and raise, you are still judged against that elevated 21x forward PE ratio. In an environment where the risk-free rate is climbing up toward 4.5%, beating estimates just isn't enough for traditional software anymore.
You have to utterly shatter them to justify the multiple.
Exactly. Meta has the AI scarcity shield. Palo Alto does not.
So given this massive collision between the AI infrastructure boom and the macro yield threat, institutional desks are universally adopting a defensive posture today.
It's very defensive.
The consensus strategy pre-market is to avoid initiating new positions on high-range breakouts. The volume profiles suggest institutions expect heavy chop, mean reversion, and severe range compression right up until that Broadcom data drops after the bell.
Yeah, they're basically letting retail momentum dictate the intraday noise while they position for the macro reaction.
So if you're managing risk today, you have to map out the specific battle lines. Looking at the S&P 500, the index is traversing a narrow pre-market band right between 7,618 and 7,621. Where is the institutional resistance sitting on the tape?
The immediate ceiling is defined by yesterday's all-time high, resting right between 7,632 and 7,638.
Okay.
The bears are going to fiercely defend that zone. If the market can push through, it's going to require a measurable cooling of that Middle Eastern geopolitical tension to drive an extension toward the secondary target at 7,663.
And above that?
Above that, the ultimate upside magnet is the massive options wall sitting right at 7,700.
And on the downside, where is the liquidity waiting to step in?
So the immediate floor is resting at the 7,582 to 7,585 level. Now, if geopolitical friction intensifies or if yields spike further, Breaking that floor forces institutional buyers to step back to the major structural support zone between 7,551 and 7,555.
And if the convexity hedging gets triggered,
If that gets triggered, 7,500 acts as the ultimate psychological and structural floor for the entire week.
shifting over to the Nasdaq 100, we are hovering near 30,674. For resistance, the immediate ceiling matches yesterday's highs between 30,693 and 30,742. But the real target for the bulls is the 31,000 level.
Yeah, that's the big one.
On the downside, the critical line in the sand, the level the bulls absolutely must hold to prevent a technical breakdown, is that support zone between 30,432 and 30,468. Now, you mentioned numbers like S&P 7,700 or Nasdaq 31,000 acting as magnets or walls.
Right.
If you are an active trader listening to this, it's crucial to understand the actual mechanism behind these specific round numbers. It isn't just arbitrary human psychology. It is an algorithmic reality driven by the options market.
Yeah, the psychology is just the catalyst, but the algorithms do the heavy lifting here. Human traders gravitate toward round numbers, so they concentrate massive amounts of call and put options at those specific strike prices like that 7,700 level on the S&P.
Right.
That creates massive open interest, forming what we call gamma walls. The market makers who sell those options, they have to remain delta neutral. So as the index price moves closer to 7,700, their algorithms are mechanically forced to buy or sell massive quantities of the underlying futures just to hedge their exposure.
So the closer we get to the strike price, the more aggressive that algorithmic hedging becomes. The market maker's forced buying literally pulls the index toward the number like a physical magnet, or their forced selling acts as a brick wall rejecting the advance.
Exactly. It is a self-fulfilling mathematical prophecy built entirely on top of human behavior.
Which perfectly encapsulates the broader tension we are seeing across the tape today. The algorithms and the momentum traders are trying to push the market to new structural highs based on the promise of an automated, AI-driven future.
But they are fighting the very physical, very immediate realities of the present.
It is the ultimate market paradox right now. You have this historic, gravity-defying momentum of the AI infrastructure build-out, led by companies like Marvell and Broadcom, where capital is just being deployed at an unprecedented scale to build the digital architecture of the future.
Right.
But directly opposing that momentum, you have the brutal reality of the macro plumbing. We have a physical conflict in the Middle East. Brent crude oil is surging toward $100. Global inflation is proving remarkably sticky, and a 10-year Treasury yield is threatening to trigger a massive forced institutional liquidation.
And that is exactly why the Broadcom print after the bell is the linchpin. It will either validate this massive CapEx spending and ignite the next leg of the AI rally, or it's going to expose a fatal vulnerability in the hardware narrative right when the macro environment is least forgiving.
Which leaves you with a deeply provocative thought to navigate today's session. As you watch billions of dollars pour into custom silicon, optical networking, and massive data centers to power the most advanced algorithms humanity has ever conceived, consider the vulnerability of the entire system. Are we entering a new paradigm where a physical, geopolitical choke point on a map like the Strait of Hormuz actually exerts more influence over the future valuation of artificial intelligence than the algorithms themselves? We are building the architecture of tomorrow, but its valuation is still entirely tethered to the cost of oil, the flow of copper, and the stability of the 10-year yield. Map out those key technical levels, respect the macrogravity, and stay extremely agile heading into that Broadcom print.